All right, welcome. We're going to get started today by looking at the S&P 500 like we normally do. You can see that the S&P SPY is above all of the moving averages, and we are currently super overbought right now. So you can see the stochastics, slow stochastics is above 90. So that's usually a sign where we don't buy or we sell. And let's look at our meeting notes for today. You can see from our seasonality calendar, we're right in the middle of beginning of earnings season. All the banks are reporting this week, and we have the tech stocks report towards August. You can see that August, September are traditionally poor months for the stock market. If we look at our average monthly stock market returns, you can see August, September are subpar. And you can see that we have elevated volatility towards September and October. So expect um, the stock market to either go down or be very volatile in September. You got to be ready for that. All right, let's look at what else is happening in July. We have a Fed meeting the 28th and 29th, and we have earnings season starting this week. So let's look at the earnings for this past week. Not a whole lot of companies reporting. This is the end of earnings season. This week we start with the banks: Citibank, Goldman Sachs, JP Morgan, Bank of America, Wells Fargo. You can see that there's a pattern of the banks reporting first in the earnings season for the first quarter. Um, that'll that starts on Tuesday, and you can see that that will basically give us an idea of what the consumer is spending, and it'll give us an idea of how the economy is doing. So we have a lot of banks reporting this week. We have TSMC. This is a very important report that's coming out this Thursday. They have they're the largest manufacturer of chips in the world, and their report will give an idea of how the AI narrative is going. And we have Netflix reporting on Thursday also. Um, so let's see how things go. Uh, right now we have pretty much neutral momentum. We aren't, last week it was 60% above the 50-day moving average. Now it's 67%. Um, so we have an overbought situation. The short range oscillator, the S&P short range oscillator is overbought at 2.55%. So that's a good sign that it's the stock market is either going to go down or not going to go up in the near term. Okay, so if you look at our S&P chart with the trend lines, you can see that we are in an uptrend and towards the top end of our trend lines. And we're above all the moving averages, which is very positive for momentum. But we are overbought. You can see with the slow stochastics, you can see from the slow stochastics that we are at 92. That is pretty high. So the translation is an S&P short range oscillator that is positive suggests that the market is overextended to the upside and due for a pullback. Okay, so it's not the time right now to buy new positions. It's time to either sell or don't buy. Okay, so since last week, we've had the price of oil increase. We've had the war start up again in Iran, and we had all of this. We had the interest rates go up. We have Fed leading to raising rates, Along with that, stock markets do not like rate hikes, and the stock market will go down. Recession chances go up, and the stock markets go down during recessions. That's kind of the pattern that's happening right now. Okay, so you can see in the last week, the 10-year Treasury has gone up. So with that, we have any company that borrows money or needs to fund their operations by borrowing money, they're not going to do good. Companies that pay a dividend will not be in as demand as, and so the dividend paying stocks will go down. So we have this is not good for the stock market whenever the yield rises. Let's look at some of our variables in the stock market. The price of oil is pretty low at 73, but it's up substantially from last week. So high oil is inflationary. So we're going to have higher inflation with the price of oil going up. And the dollar index is pretty much unchanged since last week. And you can see that we're kind of in a trading pattern, but the US dollar has increased um, relative to other currencies in the last month or so. The fear and greed index is neutral right now. So it was fear for quite a while, and we are now at neutral. So whenever we get to greed, that's when you don't buy. When you get to fear, you look for things to sell. So when the neutral, we're kind of in the middle, just waiting. So you don't want to take any big positions right now. The average investor is bearish. So it's been bearish. The average investor has been bearish for quite a while. And you have to think contrary to the average investor. Okay, the VIX is relatively low. Look how low that is. So people aren't really afraid right now in the stock market. So there's no fear. Um, let's look at our our emotional graph. So right now we're kind of at a point where we're neutral and not very fearful. And that's just the time whenever we have a summer we have a drawdown. So one of the biggest fears of the market right now is the AI stock bubble. We have CapEx increasing for the hyperscalers, the larger tech companies, and they're borrowing money to fund AI. So as they spend um, the quality of their earnings go down because their cash flow goes down. That's the biggest concern. And we always like to take the other side of that. Whenever the big tech companies spend money, they're actually spending on chips and infrastructure. And we're currently this week, we're going to be looking at those companies. All right. So let's look at some of the PE valuations relative to history. Right now, energy, financials, materials, utilities are some of the undervalued sectors compared to history. So, so whenever I look at this chart, I always like to try to find stocks right now that are selling at a discount in the energy and financials world. All right, hold on. Okay, you can see the sector performance year to date. We have energy sector, IT, industrials, materials doing the best. And the worst sectors are discretionary, financials, healthcare, and communication. All right, so let's look at some of the stocks going up and down the most. Okay, you can see Meta is going up a lot. There was a fear that Meta was spending too much, and now they're actually monetizing some of their spend by renting out some of their data centers. So that was interesting. Let's look at Meta's stock chart. You can see that it's been in a downtrend, and this downtrend corresponds with how much money they're spending on AI infrastructure. You can see that this move on Friday, it's still within the realm of this downtrend. They're still spending a ton of money, and they're losing a lot of their cash flow because of that. But they're overbought right now, and they're at the top end of their range. So it's kind of dangerous right now for a Meta to buy Meta. Um, so let's keep an eye on that one. The video went up because there was a couple upgrades. You can see the ones that go down the most are, we have a lot of cybersecurity stocks in the top stocks going down. We have Palo Alto, Fortinet, CrowdStrike. Whenever one stock goes down in a sector, a lot of times other stocks in that same sector go down with it. All right, let's go back to our talking points. Oh, we're going to look at all the stocks going up and down. And let's look at the sectors. We know the 10-year is going up. So as the 10-year goes up, our translation, when the 10-year yield rises, often signals expectations of stronger economic growth with higher inflation. A rising 10-year Treasury yield generally acts as a headwind for the stock market as it increases the cost of capital and offers a higher risk-free return. So that's positive for companies that don't need to borrow money. It's negative for companies that need to borrow money and high yielding stocks. Because if you have a guaranteed high yield return with the Treasury, you're not going to want to take a risk of buying utilities, healthcare, dividend paying stocks. Let's see if that matches what we're seeing today. IBB, they need to borrow a lot of money, the biotech industry, to fund their operations. That could be the reason why they're down today. Healthcare, they pay dividends. Oil, they pay dividends. Okay, so we have dividend paying stocks going down. The ones going up the most, oil and retail, materials, consumer staples, home builders. It's interesting that home builders and home construction are going up because you'd think they would go down as interest rates go up. So, all right, let's look at where we are on risk on versus risk off. Right now, we're at a risk off. We have a war happening. We have energy prices going up. We have instability in the global, in the Arab world and in Iran. So we're going to see these stocks do better in that environment. We have consumer staples, energy, utilities, healthcare, defense companies. Okay, so we already, let's look at our stock screen for this week. We see, I highlighted some of the stocks that have a PEG ratio of less than 1, which indicates they could be on sale. And a lot of the banks seem to be on sale. We have Bank of Montreal, we have Citigroup, Bank of America, Barclays. So, and they're reporting this week. So let's see what happens with their earnings reports. Okay, I found an interesting story. Big tech is paying for the AI boom and chip makers are cashing in. Um, and this story basically, this chart is just amazing dichotomy. You can see that the hyperscalers or the large tech companies, they used to have free cash flow, um, a lot of free cash flow. And now they're spending a lot of their free cash flow on AI infrastructure, such as memory, data centers. Their free cash flow is going down when the free cash flow in the, the semiconductor companies or the picks and shovels of the AI infrastructure are going up. So lately we've been focusing on the semiconductors and the picks and shovels of this story. So I thought we'd focus on a couple of the beneficiaries of the AI infrastructure spending of the hyperscalers this week. Um, Here's an article: Seagate stock rises after analyst upgrades to buy. Western Digital nabs price target hike. So this Wells Fargo analyst said that they're looking to buy STX, Seagate, with a price target of 1,100. And Western Digital, they expect this. They have a price target of 730 from 575. So whenever you have a good report like this, we know this is a picks and shovels play. Let's look at some of the fundamentals of Seagate and Western Digital. Okay, this is Seagate. You can see that their PE is pretty high at 37, but they're growing at 88%, 89%, which is pretty high. So it's growing at 89%. Its PE ratio is 37. So its PEG ratio is 0.41, which indicates it's more than half off right now. So let's look at Morningstar and CFRA to see if they agree. You can see that Morningstar hasn't upgraded their report since April, so we can't really take this report very seriously. So, but they have they say the fair value is 46% overvalued, but they're not updating their report. So let's look at CFRA. They have a buy rating, and they say buy rating reflects their competitive moat through their technology leadership and cloud relationships, which are helping the company lock in long-term contracts that improve visibility while beyond historical levels and positioning. Rising HAMR adoption offers Seagate a disproportionate share of high-capacity nearline demand, which continues to accelerate, especially with SSDs looking more expensive by comparison amid skyrocketing NAND prices. Okay, that's the theory. Their fair value calculation, they say it's overvalued by $229 a share or 25%. So this doesn't seem like that great of a deal. So if I was looking at this, I would wait for CFRA to say it's a better deal. And let's look at the Western Digital, the other stock in that article. They're growing at 83%, and their forward PE is only 30. So Western Digital is growing at 83, PE is 30. That means their PEG ratio is 0.36. That means they're on sale 1/3 the fair value price. So this one looks a little better. Their profit margins are 55%. That's 5 times what we're looking for. Return on equity is 85. That's 8 times what we're looking for. They have they have more cash than debt. So they're net cash positive. So we don't have to worry about debt. And they have 2 billion in levered free cash flow. This is a much better stock compared to Seagate. Let's look at what Morningstar says. They haven't updated this report since May, so I'm not going to take this very seriously. but they say it's 41% overvalued. Um, let's look at CFRA, what they said. They have a hold and not a buying. And they say robust near-term demand, margin expansion, roadmap execution, and secured multi-year customer commitments through 2029 position WCDC for growth above 25%. However, emerging supply constraints limit near-term upside to guidance. But they have a fair value of 1,000 a share. That means it's 77% undervalued. So they think it's half off. And that kind of matches our numbers. So we're going to be going into a period of time in the summer where all these stocks are going to be going down because the whole market goes down in the summer. So keep your eye out on this one. We'll keep our eye on the fair value. Um, okay, so this is another reminder that you make more money during the bull markets than you lose during the bear markets. So it's a pretty good idea to keep a buy and hold mentality when you're investing. And let me see. That is all I had for today. I hope you enjoyed the talk, and I'll see you next time.